Your money-making broadcast starts now. Good evening, Canada. Today is May 22nd, Friday. Here are the top stories moving the markets. We are seeing a complex tug-of-war as Brent crude climbs above $103, fueling our energy sector, while the tech world reels from Nvidia's latest earnings reaction. We will dive deep into why the TSX is showing resilience despite a global overbought signal. Our first big story today focuses on the critical energy pivot we are seeing on the TSX. Brent crude has surged to $103.9 for dollars, a 1.33% increase, which is providing a massive tailwind for Canadian oil sands and pipeline assets. Java's analysis indicates that while the broader S&P 500 and Nasdaq are flashing overbought warnings with RSI levels hitting 72 and 74 respectively, the energy sector is acting as a necessary hedge. For Canadian investors, this means a shift from pure growth to resource-backed momentum. However, we must be cautious. 22V Research has warned that the combination of rising 10-year Treasury yields, currently at 4.57%, and spiking oil levels could eventually break the current bull market. If bond yields continue to climb, the cost of capital for these massive energy projects increases, potentially capping the upside. From a Java's perspective, the momentum is currently green, but we are monitoring the inverse correlation between oil and equities. When oil spikes too fast, it can trigger inflationary fears that force the Bank of Canada to stay hawkish, which is a double-edged sword for the TSX. We are seeing a strong rotation into value, and for the Canadian portfolio, this means focusing on high-dividend energy plays that can withstand a volatile interest rate environment. Moving to our second major story, we have to address the Nvidia earthquake. Even though Nvidia reported impressive growth for Q1 2027, the stock dipped, and after-hours trading remained flat at $215.0 for dollars. This is a classic case of buy the rumor sell the news. Javas has already executed a stop loss on our position at $215.91, realizing a loss of 8.63%. Why? Because the technicals showed a head and shoulders top pattern with a critical neckline at $180. For Canadian investors holding US tech, this is a wake-up call. The market is no longer rewarding good earnings, it is demanding perfect guidance. Furthermore, the emergence of Alibaba's Zhenwu AI chip and new LLMs in China is intensifying the competitive landscape. While the total addressable market for AI remains huge, the monopoly premium Nvidia once enjoyed is eroding. Java suggests that any re-entry should only be considered in the $200 to $210 range after a confirmed base is formed. This volatility in the AI sector is spilling over into other semiconductor holdings like Broadcom and AMD, which are seeing temporary pullbacks. We are shifting our focus toward AI infrastructure and networking, such as Cisco, which has shown a remarkable 25.9% gain in our portfolio, proving that the picks and shovels of the AI revolution are diversifying beyond just the GPU makers. Finally, let's look at the macroeconomic landscape and the Bank of Canada's precarious position. Current Fed rates stand at 3.64%, and polymarket data suggests a high probability of further hikes through July 2027. For Canada, this puts immense pressure on the loonie and the BOC to follow suit to prevent capital flight. We are seeing unemployment rise moderately to 4.3%, while inflation expectations remain stable at 2.57%. This is a tricky environment. Bank of America has issued a bull capitulation warning, noting that investors are flooding out of cash and into stocks, which is often a contrarian sell signal. With the S&P 500 at 7,473.47 and the Dow at 50,579.70, we are near 52-week highs, but the RSI levels are screaming overbought. In Canada, this means we should be looking at defensive anchors. We've seen this with Fair Isaac Canada or CP Rail, where stability and essential services provide a buffer. The correlation between the US dollar and stocks is currently strongly negative at -0.800, meaning a weaker dollar typically fuels the rally. However, if the US economy overheats and the dollar strengthens, Canadian growth stocks will feel the pinch. Our strategy is now focused on capital preservation and selective momentum, avoiding the fear of missing out that is driving the current market euphoria. To wrap up today's session, we are navigating a market that is technically overextended but fundamentally driven by energy and AI. While the indices are hitting record highs, the RSI levels suggest a correction is overdue, making our move to a 65% cash position a prudent defensive play. Now let's get into the Java's recommended lineup for the coming week, tailored for different risk appetites. For those seeking a safe haven, the father of modern value investing, Benjamin Graham, would choose SoFi Technologies, SoFi, at $15.62. Despite a 5.1% dip, the safety margin is still intact relative to the 16.46 entry. With the fintech sector recovering, as seen by Mercury's $5.2 billion valuation, SoFi represents a calculated risk with a clear stop loss at $14.82. For a balanced approach, the legendary Wall Street manager Peter Lynch would favor Cisco Systems, CSCO, at $120.41. Lynch loves businesses he understands, and Cisco's role in AI networking infrastructure is a clear, tangible growth driver. Having secured a 25.9% profit, he would likely suggest a partial profit take of 50% while letting the rest ride the AI wave. For the growth-oriented investor, the world's leading innovation fund manager Cathie would point toward Broadcom, AVGO, at $414.14. Despite the current semiconductor adjustment, the synergy between AI chips and VMware creates a massive competitive moat. She would view this dip as a buying opportunity for long-term structural growth in AI infrastructure. Finally, for the contrarian or low-cost play, the global investing master John Templeton would choose Carnival Corporation, CCL, at $25.98. Templeton specializes in buying when others are fearful. With cruise demand remaining resilient and the stock showing a 2.1% gain today, this is a classic recovery play that benefits from the ongoing travel boom regardless of short-term oil price volatility. Subscribe for daily Canadian market insights. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.